Sorry about that. All right, and then we have cash that we spent $10,000. Second, the company paid for $4,000 in advertising expense. On the 30th, the company reported $15,000 in cash sales, so we get cash of 15,000. And sales of 15,000. The company reported $2,100 in sales on credit. So we are going to do debit accounts receivable. Because we delivered the merchandise, so we are entitled to receive payment for it. So we can record the sale. And that's 2,100. And then the inventory manager reported that $4,500 remained in inventory. So what we had is our beginning balance in inventory was 0. Okay. We added to it our purchases. And our purchases were $10,000. We have our ending balance of 4,500. And that should tell us what we used, which is also equal to the cost of goods sold. And in this case, it's 5,500. If we were to post the transactions in the account from the journal entry for that inventory, for that merch inventory account, we'd have had a $10,000 debit. And then when we put our cost of goods sold in, we're going to put in minus 5,500. And we'll end up with our ending balance of 4,500. Okay. So we have cost of goods sold and merchandise inventory. Of 5,500 for the entry. And then the last entry, the company pays salaries and wages of 5,800 in cash. So we have salaries and wages expense. Cash for 5,800. So what I'd like you to do now for just about 2 minutes is just go down and mark each of these as asset, liability, revenue, expense, or equity. Because it's going to help you categorize. To be perfect. It's just something to say, okay, am I getting this? Am I not getting it? Okay. In a minute. Okay, I'm not going to ask you to call these out. I'll just kind of go through them. If you have a question, please feel free to stop me. I just put this column in for ease, but you can just write it right in there. So cash is an asset. Common stock is equity. Merchandise inventory is an asset. Cash is an asset. Advertising expense is an expense. Bless you. Asset, revenue. Accounts receivable is an asset. Sales is revenue. Cost of goods sold is expense. Merchandise inventory is an asset. Salaries and wages an expense, and cash is an asset. Any questions? So now, what do we want to do? We want to account for the revenues and expenses to create an example income statement. So sales or revenues, those are, again, interchangeable. I don't care what you use, just realize sometimes in your problem, you'll have a drop-down box to choose from. Sometimes it'll say sales, sometimes it'll say revenues. They mean the same thing. Okay. Now, I'm just going to put in parentheses here, we had a $15,000 sale plus a $2,100 sale. So this is 17,100. We have our expenses. Cost of goods sold. We know that that was 5,500. See that face? What did I do? Yes. I said 17,000 and I typed 17. I said 71 and I typed 17,000. So thank you. And then selling expense. And that was the advertising, $4,000. And then the last one was salary and expense. Wages. And that was 5,800. What you want to do is total them up there, and I end up with 15,300. So my net income is 1,800. Yes. So that's a great question. And let me pull up our financial statements, because this isn't one of those things that's across the board in the way that they report these. So typically, obviously, this is a mass. You have their operating costs. So they have selling general and administrative all in line. Is part of selling costs. So basic. Here, if it's usually we're going to categorize them into 2 or 3 categories. It'll be selling, general, or administrative. And advertising rolls up into selling. Good question. And then we know this little note here for our purposes. Ignore income tax. And now we want to do a retained earnings statement. And our retained earnings statement starts on March 1, because we just created a company. So what we're going to do is add net income, which is 1,800. Now, if we had any other additions or transactions with stock, we would add those up as well. Generally speaking, in these basic questions, you might have dividends, but we didn't have any dividends. So here, we're just going to put in 0 and then retained earnings. Ending balance, March 31 is going to be equal to 1,800. So then we have to record that onto our balance sheet. And so our balance sheet has cash. We have accounts receivable. And then we have merchandise inventory. So our cash balance comes from here. Right? I posted all the transactions into a journal account. We had a debit 45,000, and then we took out 10,000, so that takes us to 35, 4,000 to 31, 5,000 more takes us to 26, and 800 less would be 25,200. Is our ending balance. So we have 25,200. And in accounts receivable, we didn't receive any payments on it, and we made one sale for 2,100. And our merchandise inventory comes from here. We had a debit of 10,000. We took out 5,500 because we knew our ending balance was 4,500. Great, take a header. All right, so our total assets. We add those numbers up and I get 31,800, but always checking. And on the liability side, we would normally have accounts payable. But in this case, we don't have any balance in our accounts payable, so that's nothing. We have no liabilities. We have common stock, which is part of our equity. That was that $30,000 initial investment. And then we have retained earnings of 1,800. And so total liability and stockholders' equity is 31,800. I think do you guys have enough space underneath that? A little bit, okay, good. You guys aren't responsible for this, but your questions a lot of times don't if they have. So what I want to do is just go back a little bit and add a couple details to here. So I'm going to put in kind of another column to the right. And you don't need to add a column. This just keeps me a little more organized. But if we look at what type of cash flow effect that any of the transactions have, we have in three categories. We have three types of categories for the cash flow statement. We have operating, investing, and financing. Those are the three categories for the cash flow statement. So whenever we see cash as part of the entry, we want to classify it as one of those categories. And so kind of the simple question, is it part of operations? That first one, investing is long-term assets are non-current. Or investments. Remember, companies make investments, especially if they have a lot of cash sitting around. They don't do nothing. And financing would either be debt, payments, or borrowing. And transactions with owners or shareholders. So as we go through these, this first one is a transaction with ownership, so that is financing. Buying inventory is part of their operations, so that's operations. Paying for advertising is part of operations. Sales, receiving it is part of operations. No cash effect here with accounts receivable and sales. Remember, if it doesn't say cash, it has no effect on the cash flow statement. So we go all the way down to the other one. And we have operating. So then a quick cash flow statement. Would say cash inflows or outflows from operations. So if we go back and we look at the ones with our outflows, or excuse me, with O's for operating, we see we had 10,000 in outflows, 4,000 in outflows. We got 15 in inflows and 5,800 in outflows. So $15,000 in minus 10,000 minus 4,000 minus 5,800. So 19,800. So we have a net $4,800 outflow from operations. Which in parentheses. We have cash inflows or outflows. Investing. In this case, we didn't have any. So that would be zero. If we bought a building or we bought equipment with cash, that would show up here. And then the last one, cash inflows or outflows. Financing. In this case, we got $30,000 from the owner to start the company. And so we have net change in cash due to just net change of cash. And here we have 25,200. And so we say beginning balance in cash is zero. And so our ending balance in cash should be 25,200. Because you add that change in cash. A quick peek at what this kind of looks like in reality. By the way, we do the statement of stockholders' equity. And this is what it looks like for one company for basically a year. They do common stock, treasury stock, other accumulated profit employed in the business is retained earnings, by the way. Other comprehensive income or loss is something for intermediate 2. Non-controlling interest is basically somebody else owns a part of the company. And then the last, they get into the cash flow statement. So this is a complicated one, but you'll see cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, and then you'll see, okay, increase or decrease in cash. Cash at the beginning, add those two, and you get your cash at the end. And notice, what does that tie out to? That ties out to our cash balance of 25,000. Any questions? Have a great weekend. See you on Tuesday.